Buying property in a self-managed super fund, particularly if you're a business owner, can be incredibly powerful. It can be powerful as a way to grow your business, grow your wealth. It can be tax efficient, but it also, potentially as a business owner, you might not have $500,000 lying around as a deposit to go and buy premises for the business. Now I'm going to talk you through two perspectives. I guess one is a financial advisor who advises in the space, and the other is somebody who's done it personally. So my business premises are owned by the self-managed super fund, and the business rents the premises from the super fund. So incredibly powerful stuff, but please understand this is a complex area, so you do need that team around you. Number two, this is not personal advice. You need to go and get that personal advice specific to you, your business, your super, and your own circumstances. Let's run through 4 different entities that you might see pop up as you go through the journey of learning more about self-managed super fund property purchase, and particularly where we've got some lending involved. Number 1 is going to be the company as the trustee for the super fund. Now, yes, it is possible to be individual trustees for a self-managed super fund. I'm not a big fan, and you won't find a lot of advisors or accountants in this space who are going to recommend that. Having a company or a corporate trustee gives you an extra layer of protection. There's a whole bunch of other benefits that potentially can come down the track. So, company or corporate trustee. Second one is the self-managed super fund itself. That is effectively, it is a tax structure, nothing else. It comes with a lot of rules and it comes with a lot of restrictions, but it is incredibly powerful. Third one is called a bear trust. Now, the bear trust pops up as and when you introduce lending or a mortgage into the equation to buy property, and its sole purpose, its bare purpose, is to hold that property. That is literally all it does. It holds the property as long as there is a mortgage in place. Fourth one, this is the one that I really like to see, is the business, because the interaction between your super fund and your business can create some incredible tax advantages, and it's beneficial not only for your super fund, but for the business as well. Great way to grow wealth. Let's have a look at what the structure could look like in very simple terms. So, number 1 up the top, you've got the corporate trustee. Now, you will be the directors of that company. You've then got the self-managed super fund, and over here we've got the bear trust. Now, again, that bear trust just sits there and holds the property for as long as there is a mortgage. As soon as the mortgage is discharged, the property then belongs to the self-managed super fund. There's no tax implications when that transfer happens. There are no stamp duty or tax implications at all. Very important. Let's have a look at how this could be set up in reality. So we've got the self-managed super fund over here, which you'll note does not own the property. The property is held in that bear trust, and there is an agreement with the security, mortgage, and the security is held over that property. Now, there's a little piece of subtlety around here, and it is called a limited recourse loan. The reason there's limited recourse is if the super fund stopped paying, so the super fund is responsible for paying the bank, the mortgage repayments. That's okay. But if they stop paying, the bank's only recourse, the only thing they can get a hold of to cover the debt, the mortgage, is to sell that property. They do not have access to anything else inside that super fund. It is a layer of protection. Now, because there is the layer of protection for the super fund, it is more risky for the lender. A lot of the banks have pulled out of this space, so instead of seeing bank, we may actually see non-bank lender, but it's more risky for them. And because it's more risky, they're going to charge you a higher rate of interest. Now, I wouldn't be surprised if you saw an extra 2% on top of a normal investment property loan. Here's your business. So the way that it works, business rents the property from the self-managed super fund. Rent goes from your business to SMSF. The rent then goes to the bank or the non-bank lender to pay the mortgage, and that covers the repayments there. So it comes from your business to your super fund, out to the lender. I'll talk you through some of the subtleties there but it's incredibly powerful. And the reason it's powerful is you sit on both sides of this equation. So as the business, you, as I said, as the business owner, you may not have had this big lump sum of cash to go out and put down as a deposit to buy premises. But as the business, you now plant your flag in the ground and go, we live here. And this is where we're going to be for the next 10, 15, 20 years. That can shift the mindset of you as the business owner. We now have stability. Let's grow this thing. And really can shift your mindset. So very powerful. From a business point of view, you've got a great landlord. It happens to be you. From the landlord's point of view, the self-managed super fund point of view, you've got a great tenant, your business. Now this arrangement here, the rental arrangement, has to be on commercial terms. You can't go and sort of shovel extra money in over and above what is fair commercial market rent, because then you're trying to circumvent how much money we can get into super. It comes with all sorts of restrictions. You also can't pay no rent or below market rent, because then the super fund is actually subsidising the business, and that's not allowed. It's got to be genuine commercial terms. Please look out for that one. Got a little bit of variation, got a little bit of leeway in terms of how you could make that work, but please make sure that it's on commercial terms. Right, let's have a look at some of the numbers. Why do I get excited about this stuff? Okay, so let's look at it from a business point of view. Here I'm assuming that we're operating as a small business. Small business tax rate is 25%. So if you've got rent, and I've used 100 grand just as a round number because it works out really nicely for the maths for this guy. So 100 grand's worth of rent, $25,000 tax deduction, that's what the business claims as a deduction against the revenue. So 25 grand's worth of deduction for the business. If you own that in the super fund gets $100,000 rent comes out of the business and goes into the super fund. That is the income for the super fund, and because the super fund pays tax at 15%, 15 grand's worth of tax payable. Leaves a net $85,000 in the super fund to then go and pay the mortgage. Now what you'll notice already is that $25,000 tax deduction claimed, $15,000 tax paid, 10% differential, you're in front in this scenario by 10 grand. It's pretty powerful. But there's a couple of other ways that you could own it. If you've got the money in your own name, you could buy the property in your own name. Let's assume that as a business owner, you're probably drawing around at about 140 grand, and then the rest of the profit, it's not going to disappear, let's go disperses elsewhere. But I wouldn't be surprised if the tax rate for an individual business owner and operator is around at about the 37% mark. In that example, 100 grand's worth of rent, 37% tax, leaves you with 63 grand. Add 100 grand's worth of rent and you're adding some tax problems, but just to highlight, you'd end up in this scenario, 100 grand lands you with 63, way less than the 85. And if you were to look at perhaps running it through a family trust, I wouldn't be surprised if you've got a bucket company underneath, maximum tax rate of 30%, 100 grand in, 30 grand out for tax, and 70 grand. In the trust and the personal example, 25 grand tax deduction and either 37 or 30% going out, you're a little bit behind. There you are in front. Really, really powerful. Now that's from a day-to-day operations point of view, but at some point, perhaps the business winds up, gets sold, you move on, and now we've got to sell that asset. Now if you bought $1 million property, and let's say it grew to $3 million, you got a $2 million capital gain. In your own name, that's going to hurt because you've got a $2 million capital gain. You're going to chop that in half for your regular investments. Yes, there is the potential as an active asset to back end it into your super fund. Let's keep that one out of the equation for the moment. But you would have effectively $1 million worth of income. $1 million worth of income is going to end up with a tax bill of around and about 500 grand at ballpark figures. It's not a great equation. Do it in the super fund. Yes, potentially you could pay 15% if you held it for less than 12 months. At the 12-month mark, you're going to pay 10% tax. But if you go through the pension phase at retirement, you could effectively make that $1 million capital gain disappear. There is no tax payable. Pretty powerful stuff. So I want you to have a think about it from a business owner's point of view. I want you to have a think about the potential benefits for buying premises for the business. From a super fund point of view, so from your personal point of view, I want you to think of the power of the really good numbers that you can actually get potentially out of commercial property and the marriage of those two. Business owner, super, both of them have to win, both of them have to be in front, and it can stack up beautifully. From the business and a personal point of view, there is a tax saving potentially there. In that example, it's about 10%. I wouldn't be surprised if that was something that popped up on a regular basis. About 10% of the rent as your tax benefit. And then longer term, you've got this really powerful position potentially of if you've got a property, big capital gain, you can offload it, capital gains tax free in retirement. So that's the good stuff. Things that I'm not a fan of in self-managed super fund world is using all of your money to go and buy a regular investment property. The numbers it's very rare for me to see the numbers stack up. Commercial property, offices, industrial property, the rental income that you're going to get is significantly higher, the cash flow is better, it works beautifully. But got to go and do the numbers. You've got to go and get advice. As I said before, this is not personal advice, this is general advice only. Go and have a chat to your advisor, your accountant, your mortgage broker, your lawyer. Get that team together and make sure that everything is set up and ready to go. You don't want to set it up too early. You don't want to find out that you've rolled all of your super into a self-managed super fund and then you sit for 1, 2, 3 years as you're looking for a property. It needs to start happening at around and about the same time. Get all of your ducks in a row, find the property, get the structure set up, because remember there are probably 3 new structures to set up. If you've got a business already, there's probably 3 new structures to set up. It does take time. It takes time to get the money in, and just, the thing that I see really regularly that, is a little bit confronting is watching somebody take their super fund that has insurances in it already, roll it into a self-managed super fund, they lose all of the insurance and then go, didn't realise and can't get me. If you're going to go down the path of lending, I will always encourage people to go and get advice around the insurance. We've now got extra debt, extra risk. What does that look like? Should we have insurance? Something for you to think through, something for you to get advice on. But as I say, incredibly powerful. Hopefully this has given you a little bit of insight as to how it works and the potential advantages.